Hello, everybody. Welcome to BizFair 2022. Hope you are enjoying the presentations and obtaining a lot of valuable resources for you to use in connection with your small businesses. Let's get underway. Just a moment on SCORE. SCORE is a national nonprofit entity. I am a volunteer for the Seattle chapter of SCORE, and I strongly encourage you to look up a SCORE chapter in your area. SCORE is loaded with resources, workshops, and free business mentoring from folks who are very experienced in a wide variety of businesses and business knowledge across the board. So definitely consider SCORE as a great resource for your small business. A little bit on me. I was a lawyer for 41 years, retired in 2018. I have to say I sort of retired. I had one client who, when I was going to retire, said, Guy, that's not going to work for me. So she talked me into doing what many of you are doing, and that is form your own LLC. In my case, it's a PLLC because I'm a lawyer. And so now I have a one client, one lawyer PLLC, and I take care of this long-term client when she needs things. But that's my background. I've been a volunteer mentor at SCORE about 12 years now, and really enjoy helping people form their new entities or answering questions they have about how to properly operate their entities and move forward. Okay, today's real topic is, do I need an entity? And if I do need an entity, or I want an entity, what type of entity should I form? The questions that you want to ask in thinking about an entity all relate to third-party liability. If you are a sole proprietor, you do not have an entity, or if you are in a general partnership, you do not have an entity protecting you from third-party liability. So, if you are running a bakery and someone comes in and slips on a donut, and you are a sole proprietor, and that person feels they have a claim for their injuries, they have no choice but to sue you individually as the owner of that entity, as the owner of that business, because it is a sole proprietorship and does not have an entity. On the other hand, if you have formed an entity, be it a limited liability company or a corporation, that same claimant has to render their claim against the entity and not against you as an owner of the entity. That is the primary reason people form entities, is protection of the owners from untoward things that may arise in the operation of the business. And frankly, that was the reason that corporations were invented in Europe 400 years ago. They were invented to protect the owners of operating businesses from liability for things that the businesses do. We do have some rules of thumb. If you're in the various types of business, we would strongly urge you to have an entity. If you're doing anything in the food business, if you're doing anything in the healthcare business, any sort of products that have a dangerous aspect to them if they are misused, etc. So think long and hard when you're starting your business about whether or not you have potential for third-party claims. Now, obviously, anything can happen to anybody, but if you're in a business where, one of the first things that come to your mind is, gee, someone could get injured or something could happen which would bring a claim in favor of that person, you should then consider forming an entity of one sort or another. Okay, today we're going to talk about the entities that are in bold: sole proprietorships, limited liability companies, corporations, and social purpose corporations. Not going to talk about partnerships. And the primary reason is that as a lawyer, I would advise you to try and stay away from partnerships. Partnerships are not an entity. They are a relationship of multiple parties coming together to make a profit in some sort of business or another. But partnerships are generally a negative thing because each partner is fully liable for all the actions of the other partners, and there is no entity protection. So stay away from partnerships. We'll talk a little bit more about those and why you need to stay away from them as we proceed with our presentation. Limited partnerships and limited liability partnerships are sort of specialized types of entities that you may hear about, but they're really not appropriate for small or startup entrepreneurial businesses. If you are, however, a professional and you need a professional license in order to practice your profession, and you want to practice your profession in an entity, then you must choose a professional version of the entity. So if you want an LLC and you are a licensed massage therapist, you need to form a PLLC, or professional limited liability company. Or if you've chosen, the corporate status, you would choose a professional service corporation to run your business. However, that is really, there are very few distinctions between the professional versions of those entities and the regular versions of those entities, other than you do have to obtain professional liability insurance. Okay, sole proprietorships. Sole proprietorships are still the number one form of business structure in the United States. More businesses are sole proprietorships than any other type of entity. But as we've discussed, no entity is formed. There's no liability protection from an entity. So you need to think long and hard and get insurance when you are forming that type of entity. There's no particularly special tax treatment for a sole proprietorship, but it is taxed in a manner that is considered favorable because no double taxation from an entity level, etc. And the business is simply, the profit or loss from the business is simply reported on the owner's personal tax return. If you have a if you have a sole proprietorship, a business license is required. Even a sole proprietor must get a Washington State business license if you're practicing here in Washington, or a city or county license, depending on where your business is located. A sole proprietor can be a single individual or a married couple, but a sole proprietor cannot be multiple unrelated people. That would be a partnership, which you do not want to be in. So if you have a sole proprietorship and your neighbor wants to join you, you guys need to form an LLC or a corporation in order to protect yourselves as you move forward with the business. Limited liability companies, probably the most popular form of entity when entities are formed. A limited liability company provides you protection of an entity, but pass-through tax treatment. In other words, everything passes down through the entity to the individual owner or owners. No tax is paid at the LLC level. The ownership of an LLC is called a membership interest, and owners are members of the LLC as opposed to shareholders, which is what you would be in a corporation. An LLC can be member managed or manager managed. Most often, you would want to choose to be member managed. Manager managed entities are usually multiple owned entities where they hire a third-party manager to speak for and obligate the corporation. There's widely misunderstood concept that you can't have a single member LLC. You absolutely can have a single member LLC. My guess is that most LLCs are probably single member LLCs. And if you and a spouse own the LLC together, it is still considered a single member LLC, which is a good thing. Or you can bring other people into your LLC, at which point it is a multi-member LLC. We'll talk about some of the pros and cons of doing that, one of which is a separate tax return is required to be filed at the LLC level if more than spouses are owning the entity. So if any third party owns the entity with you, a separate tax return is required. No tax is paid at the top again. It all flows down through to the owners, but a separate and somewhat expensive to prepare tax return is required. One cool thing about a regular limited liability company that is not elected S Corp status, which we'll talk about in a second, is that it can specially allocate profits. So if you have two owners of an LLC, one of whom is wealthy and the other of whom is not so wealthy, and the wealthy person really doesn't need any more income, you can specially allocate the income of the LLC to one owner or the other. It all evens out eventually in the wash and how the accounting is done, but it is a opportunity that many people can take advantage of, usually with their CPA's help, allocating profits and losses, especially among the respective owners. LLCs have much more flexible management opportunities than do corporations. They're managed by the members as members and owners of the entity. LLCs can choose to have officers and can choose to have a board of advisors or a board of directors, but they don't have to. One disadvantage of LLCs is that sometimes when you've created an LLC and you're rocking and rolling and really making good money and somebody wants to buy you, sometimes investment bankers and Wall Street brokers, et cetera, are less comfortable with selling and buying LLC membership interests than they are stock in a corporation. But generally converting, when that day happens and the Wall Street bankers are knocking on your door, generally converting an LLC to the corporate status is very easy, usually without a lot of, if any, tax ramifications, and it's pretty straightforward. Plus, somebody who really wants to pay you the big bucks for your entity is going to be happy to pay for and implement that conversion from an LLC to a corporation. Married couples who own an LLC, it's a so-called disregarded entity for tax purposes. Again, that just means everything flows down through to the married couple owners, and there's no tax or tax ramifications at the company level. One of the handouts you should have received or will receive if you haven't already as part of this presentation is a pretty comprehensive document about using limited liability companies here in the state of Washington. I think you'll find it pretty helpful. Corporations. So corporations are obviously the oldest form of entity. As I mentioned, 400 years ago, corporations were formed in Europe to protect owners from third-party liabilities. Corporations are harder to form and harder to maintain. You have to create officers. You have to have a board of directors. You have to elect the board of directors by the shareholders. You have to hold annual meetings. So there are more formalities required in the corporate status. More people, as I mentioned, are probably familiar with transferring stock than they are transferring membership interests in LLCs, although that is changing and things are becoming much more readily marketable in the LLC world. So investors are quite often happy to buy LLC interests. But you will hear that many times, gee, you've got to be a corporation if you want the Wall Street bankers to end up buying you. But like I say, they can convert you when the time comes. Um, One issue for a regular corporation is regular corporations are subject to double taxation. What that means is when Ford Motor Company, the corporation, earns $1, then it does something with that dollar, makes money on it, or maybe it reduces it down to 50 cents. And that 50 cents is a dividend or distribution paid to the shareholders of Ford Motor Company. So that dollar got taxed at the corporate tax rates up top, and the 50 cents distributed to the shareholder got taxed in the shareholder's hands down at the bottom. And that is the so-called double taxation. People ask, why in the heck would anybody ever set up an entity with that double taxation? And the answer is big corporations spend millions and millions and millions of dollars on lawyers and accountants and CPAs to figure out how not to pay the corporate tax rate on that first dollar when it comes in. So there are ways around the double taxation, but on its face, corporations are subject to double taxation, and that is seen as an undesirable element that contrasts it with LLCs. A new, relatively new type of entity in the state of Washington is the social purpose corporation. The easiest way to explain this is to tell the Ben and Jerry's ice cream story. Ben and Jerry, invented this great ice cream, and their company was doing fantastic, and it made a lot of money. Ben and Jerry were very charitably minded. They gave away millions and millions and millions of dollars to charitable purposes, etc. When it came time for them to retire and sell the company, they found a buyer who was likewise equally charitably minded as they were. Unfortunately, the rest of the shareholders said no. The purpose of the corporation and the purpose of the corporation laws where we were formed, or where that company was formed, was to maximize the return to the shareholders. So that they were not allowed to sell the company to the entity that was like-minded to them. Well, two things happened. One, they did a pretty good job. They were the majority shareholder. They did a pretty good job negotiating the deal with Unilever, who turned out to be the ultimate purchaser, which is a giant international corporation. They put a lot of constraints on them, and they were able to get them to still do a lot of charitable things. The other thing they did was engage in a nationwide campaign to get states to adopt a social purpose or social benefit corporation law structure. And that structure says, okay, the corporate laws do not require just profit maximization by the corporation. A corporation can have two purposes, a for-profit purpose and a social benefit purpose. And the law that was adopted in the state of Washington, a social purpose entity can benefit the corporation's employees, suppliers, or customers, the local, state, national, or world community, or the environment. We are seeing more and more social purpose corporations formed. Most of it seems to be for marketing purposes. So people forming these entities generally want to market that they are sustainable and that they're fair and that they're social purpose, etc., which is, admirable and part of the reason that they should have been formed. But that's still an option for anybody that wants to do it. There are not social purpose LLCs in the state of Washington. I think there are in California, but not here in Washington. Here's a little chart, kind of compares the various types of entity ownership and various components and aspects of each one. Tax treatment, a little bit more for taxes for you. Again, pass-through treatment is desirable, and it's available to most all entity types. Remember that special allocation of profit and loss that I talked about in a regular LLC cannot be made in an S corporation or an LLC taxed as an S corporation. It can only be utilized by LLCs taxed under the normal LLC structure. Um, let's talk for just a moment about S Corps. Remember, once again, it's not a different type of entity. It is an election with the Internal Revenue Service to have your LLC or a corporation, if you have one, taxed as though it comes under the S Corp rules in the IRS tax code. The way that it benefits an LLC, for example, is you split the income of the company between salary paid to you as one of the owners and a dividend paid to you as one of the owners. The dividends are not subject to self-employment taxes. The salary obviously is. And if you are operating a regular LLC that has not elected S Corp status, all of the revenue is attributed to you, and it is all subject to self-employment taxes. What we usually say at SCORE is when your revenue hits the $60,000 level per year, you should look into making the S Corp election with the IRS for your LLC. And that is because at that level, you can save, from $1,000 to $2,000 or $3,000 per year in taxes. So it can definitely benefit you. Once you start hitting those kinds of revenues, you want to think about making that S Corp election for your LLC or corporation entity. Again, I can't hammer enough that an S Corp is a status with the IRS, and an LLC can elect it just as easily as a corporation can. Some restrictions: S Corp status only allows one class of stock, so you can't have, it doesn't mean everybody has to have the same amount of shares, but one kind of stock can't receive a preferred payment priority. Ownership of S Corps are restricted to natural persons. Other entities can't own S Corps. You have to be a U.S. citizen or a resident alien to own. And you've got to make that election within 75 days of the start of your tax year. Here's just a list of some of the tax forms that the various types of entities use. Okay, where are you going to form your entity? Washington State is certainly a good place to form entities. By the way, there'll be another presentation this afternoon by our friends at the Secretary of State's office and the Department of Revenue to walk you through the steps necessary to form a corporation or an LLC here in Washington. Washington has a modest tax burden. Its statutes are nice and modern. It's good. Many times you'll hear, oh my gosh, you should have formed your entity in Delaware. Delaware earned a reputation decades and decades ago for being extremely management friendly. In other words, its laws and its corporate cases, etc., favor management of the company as opposed to the shareholders of the company. But Delaware, has done a nice job marketing and making itself perhaps appear a little bit more valuable than it really is. But a lot of people insist on forming their entities in Delaware because of its reputation. Things are usually a little more expensive there. One thing Delaware does have is a very sophisticated history of corporate law and dispute resolution. And a lot of other states look to Delaware to see how they solved the problem, decades ago, even though it's the first time in our state that we may be seeing it. Other people like Nevada and South Dakota for low tax purposes. Again, the difference between Washington and those states is really pretty small. Remember, depending on where you're doing business, if you have a significant enough nexus in other states, you have to register to do business in those states in addition to your home state. How do you properly maintain your entity? Always pay your annual report fees and annual renewal fees with the Secretary of State. Respect the entity, keep your separate bank account, do all of your business under the name of the entity, not in your personal name. Don't mix your personal and business assets. You want the rest of the world to know they're dealing with an LLC or a corporation when you are working on your company or for or on behalf of your company. Sign documents, similar to this example, where you are showing that you are an LLC. You sign personally, you give up liability protection individually, and you do not want to do that. You formed an entity to protect yourself from individual liability. Likewise, if someone says to you, gee, I want you to be a tenant individually, or I want you to sign on this loan, you say, no, my LLC will be the borrower, or my LLC will be the tenant. If you make me, I'll be a guarantor, but I want my LLC to be the primary obligor. Okay, multi-owned entities. Just got a minute or two left here. If you have multiple owners of your entity, you need to be ready. More sophisticated tax returns are going to be required. A written agreement between the owners should be established, called an LLC operating agreement or a shareholders agreement in corporations. You need to answer sort of a lot of these company questions in such an agreement. What are my respective roles? What am I supposed to do, etc. Check the handout that was included with your materials. There's a fairly sophisticated LLC operating agreement there, and it gives you kind of an outline. It's more than any one of us would want to have to deal with, but it's a very thorough agreement covering many of the issues that you might want to address as a multi-owned entity. Okay, that is it for today. Enjoy the rest of your BizFair time. Good luck in your business. Think about contacting SCORE, and have a good rest of your day here at BizFair 22.